Welcome to this explainer. Come on in, grab a seat, and let's just treat our time together today as a private one-on-one financial consultation. Now, if you're tuning into this, chances are you work incredibly hard. You might even pull in a really fantastic salary, but you still kind of feel like you're running endlessly on this high-income treadmill, right? Well, today, we are going to hit the hard stop button on that treadmill. We're going to completely dismantle all those common myths about what it actually means to be rich, and instead, I'm going to hand you a concrete, actionable blueprint for building true, lasting financial security.
As your trusted advisor, let's take a quick look at our roadmap for today. We're going to unpack the high-income illusion, look at earning versus building assets, clarify good debt versus bad debt, tackle surviving lifestyle creep, and finally, unlock the psychology of compounding. It's a lot, but before we can even think about building a portfolio, we really have to fundamentally shift your mindset about money.
All right, Section 1, the high-income illusion, where title does not equal wealth. So let's dive into this by examining a really dangerous and honestly very common paradox that we see among high earners. Let me just completely shatter a preconceived notion for you right out of the gate. Think about a highly respected consultant anesthetist pulling in £105,000 a year. The title, the prestige, all the letters after her name, they literally scream wealth, right? Yet, let's say she rents a flat and only has £11,000 in savings. On the flip side, consider her plumber. He earns roughly half her salary, about £55,000. But he owns his home outright, he's got a rental property generating passive income, and his investment account just crossed £120,000. This just brilliantly illustrates our very first core lesson. Your job title and your salary absolutely do not equal wealth.
So, if a fancy title doesn't equal wealth, what actually does? Well, think about this number. $8 million. That was the staggering net worth of a man named Ronald Read when he passed away back in 2014. Now, you might be wondering, who on earth was Ronald Read? Was he some hotshot hedge fund manager, a tech founder? Nope. He was a rural Vermont janitor and a gas station attendant. The guy hitchhiked to high school, bought a $12,000 house, and just lived in it his entire life. His secret? He simply saved what little he could, invested it, and waited. It just proves that wealth is overwhelmingly about your behavior, not your formal intelligence or pulling in a massive paycheck.
Let's actually contrast Ronald Read's success with another man who was in the news right around the exact same time, a guy named Richard Fuscone. Now, Fuscone was a Harvard-educated, incredibly successful tech executive living in Greenwich, Connecticut. The guy was brilliant, but he borrowed heavily to expand an 18,000-square-foot home, complete with 2 elevators and 7 garages, costing $90,000 a month just to maintain. I mean, wow. So when the 2008 financial crisis hit, he went completely bankrupt. He lost everything. 2 men, one with every single educational and income advantage you could ask for, who ended up with nothing, and one with a humble wage who basically built an empire. The deciding factor? It was entirely about behavioral control.
Okay, moving on to Section 2, earning versus building assets, and breaking the ceiling. To really do this, we need to diagnose the exact mechanism of wealth, which means we have to redefine how you view your daily labor.
Here's the fundamental flaw of relying on hard work alone. Listen, no matter how skilled you are and no matter how much you charge per hour, your income is permanently capped by the 24 hours in a day. You can't clone yourself, right? If you're only focusing on earning money from your job, you are just trading time for money. It's a hard ceiling that you will never, ever break through with your labor alone.
And that brings us to the solution. The International Financial Reporting Standards formally defines an asset as a present economic resource controlled by the entity as a result of past events. Okay, that sounds incredibly dry, doesn't it? Let me translate this jargon for you as your advisor. An asset is simply a vehicle that earns money around the clock. It doesn't sleep, it doesn't need a vacation. When you build assets, whether that's an investment portfolio, a business, or real estate, you completely shatter that 24-hour ceiling.
Which leads us perfectly into Section 3, good debt versus bad debt, and understanding leverage. Let's look at how this builds into risk management, because honestly, to protect those hard-earned assets, we absolutely must understand the dual nature of debt.
See, not all debt is created equal. Good debt actually enables you to buy lasting, important things that move you in a positive financial direction over time. Think of a mortgage on a home. It's collateralized, usually carries a lower interest rate, and often funds an asset that goes up in value. Bad debt, on the other hand, is toxic. This is when you use high-interest, unsecured borrowing, like credit cards, to fund your routine daily living expenses or consumer goods that just lose their value the second you buy them.
If you really want to achieve financial security, you have to eliminate that bad debt to make room for actual asset growth. And when it comes to managing that debt, I want you to keep this firm boundary in your head: 42%. This is the absolute maximum debt-to-income ratio you want to strictly observe. You calculate it just by dividing your total monthly loan payments by your pre-tax income. If your debt pushes past this 42% threshold, consider it a massive, flashing red warning sign. It essentially signals a dangerous shift from manageable leverage straight into genuine financial strain. All right, Section 4, Surviving Lifestyle Creep, or, as I like to call it, the silent wealth killer. This perfectly transitions us into the psychological pitfalls that routinely destroy high earners.
Now, let's conceptually break down this silent wealth killer. Imagine this. You finally get that big promotion. Suddenly, you feel this immense pressure to live the life you quote-unquote deserve, right? So you upgraded the fancy German saloon car. You put in the absurdly expensive Faro and Ball kitchen. Here is what happens. First, your income goes way up. But second, your expenses rise perfectly parallel to your new income, which leaves the final piece, the actual assets you've built, at absolute zero. You're earning more money, sure, but you're effectively just as broke as you were before. You just have nicer stuff.
I really want you to listen to this quote from Morgan Housel and just let it sink in for a second. There is no reason to risk what you have and need for what you don't have and don't need. As your advisor, I'm telling you right now that the single hardest financial skill in life isn't picking the perfect stock. It's getting the goalpost of your lifestyle desires to just stop moving. Once you cover your comfortable basics, honestly, everything else is just feeding your ego.
That brings us to our final part today, Section 5, the psychology of compounding, the quiet driver of wealth. Let's move right into this final strategy portion of our session, focusing on the true hidden driver of monumental wealth. If I could prescribe just one foundational text for you to go read after this consultation, it would absolutely be The Psychology of Money by Morgan Housel. The core lesson here is profound. True wealth is actually what you don't see. Wealth is the sports car you decided not to purchase. It's the diamond you didn't buy. It's that first-class upgrade you declined. Wealth is financial assets that haven't yet been converted into the physical stuff that everyone sees. If you spend money just to show people how much money you have, well, that is quite literally the fastest way to have less money.
Let's look at the ultimate master of compounding, Warren Buffett. We all know the guy's worth tens of billions of dollars. But what if he had just been a normal person? Think about it. What if he hadn't started investing when he was literally a child, and instead started at age 30 and retired at 60, earning the exact same percentage returns? His net worth wouldn't be over $80 billion. It would be $11.9 million. That is 99.9% less. His real secret isn't just his investing skill. His secret is the sheer, unadulterated time he allowed his money to sit there and compound.
So let's bring this all together into a practical, actionable blueprint for your financial security. First, you've got to flip your habits. Invest first and spend what's left, not the other way around. Second, treat your savings not just as a fund for a future vacation, but as a real hedge against life's inevitable surprises. Third, have patience. Allow decades for compounding to work its magic. It's kind of like growing an oak tree. You won't see daily progress, but over decades, the results are just staggering. And finally, remember the ultimate goal here. Use your money to gain control over your time. Financial independence doesn't require a doctor's income, it just requires a high savings rate and emotional discipline.
I want to wrap up our consultation today with a pretty stark, provocative question drawn from the research in The Millionaire Next Door. I want you to ask yourself right now, could I live on the equivalent of 6.7% of my wealth? If you want to achieve the true security we've been talking about today, you have to minimize your taxable income and maximize your asset appreciation. Stop running faster and faster on that treadmill just to fund a high-consumption lifestyle. Start building those quiet, unseen assets that will eventually set you free. Thank you so much for joining me for this explainer today, and I really hope this completely changes how you look at your very next paycheck.